Hi everyone, welcome back to this week's edition of RHO Market Chat. So today I want to talk about S&P price action and the market headwinds. So we have had COVID tormenting the market for about 2 months, and a lot of bad news really centered around COVID. And then we had the escalation of China-US tension, and now we have another headwind, and that is the US riot over George Floyd. So today we can see that almost every city in US, they had street protests, all right, in a scale that has really never been seen before. And so that's quite serious. And then also we have S&P price action, which is very bullish. And I hear of many traders and investors saying that the S&P price action is indicating that we are, or we could be, in a bull market. Is that so? Should we believe it? All right, I just want to refer you to history. Could history be telling us otherwise? All right, so this is S&P as of last week, and so this is where we fell from February high all the way to March, middle March, and then S&P did a spectacular rebound, and now S&P is only about 15% from the all-time high. What is catching a lot of traders and investors' eye is the S&P has moved above the 200-day moving average, and at the same time, S&P has crossed over the 61% or 61.8% retracement level of the Fibonacci indicator. So these two technical indicators seems to suggest that S&P has now turned bullish. So question is, should we believe it? So let's take a look at the historical pattern of S&P. What has history got to tell us? So let's take a look at 2008, and that is a great financial crisis. So similarly, we had a 19% fall. We had a rebound, all right, all the way taking us above the 200-day moving average and very close to the 61.8% retracement level. And then we had the real meltdown, and the market crashed 53%. So when the prices goes above 200-day moving average, and when it is creeping very close to 61.8%, well, to a lot of people, it could mean we are in a bull run. But to me, I think we have to be cautious because history is telling us otherwise. Okay, let me give you another example, right? So this is 2018. And in 2018, similarly, we had S&P falling almost 12%, did a spectacular rebound. And this time, it looks like what we are having now. All right, this time, it broke above 200 days moving average, and it also broke above the 61.8 fibo retracement level, which is bullish. But see what happened after that? S&P crashed 16%. All right, when you look at these indicators and how the market has moved today, you want to be cautious, because touching or moving above the 200-day moving average and above the 61.8% fibo retracement after a very, very steep fall could be dangerous. All right. So let's talk about what is going on now, current headwind. So we see a new Cold War brewing. We see almost every other day, the last couple of weeks of headlines, we've seen escalating US-China tension. And I believe that this tension could remain high all the way to the run-up to the US election in November. So one of the highlights last week, all right, was Donald Trump's intention to remove Hong Kong from its privileged trade status with the United States. All right, so that will really mean that the future of Hong Kong as a financial sector will become more Chinese-centric and focused. Well, trade war is never good for everyone and is especially bad now for the world because the Chinese share of the world GDP has increased. You know, back in 2010, it was about 23%. Today, we're talking about 31% share of the global GDP. And that is why we need to be worried when we have an escalating tension. So, as I've said, US intends to remove the special status enjoyed by Hong Kong. And if this US tension is followed by sanction, all right, it will severely impede Hong Kong's role as an international financial center. But I don't believe that economically it will hurt Hong Kong in a big way because today Hong Kong exports very little to the US. And but in fact, a lot of US businesses actually used Hong Kong as a gateway to the world. All right, so last week also we saw the US Secretary Mike Pompeo indicates that Hong Kong does not continue to warrant treatment under the US law in the same manner as the US law will apply to Hong Kong before July 1997 due to the lack of autonomy. So what is all this implication, all right, to the stock market? If Hong Kong, right, if the one country, two system does not exist anymore, what is the implication on the Hong Kong stock market? So this is the implication, all right. If you see the price action last Friday and yesterday, all right, you would have seen that upon learning of the news or upon announcement of the news of Hong Kong losing its special privilege status, we saw that the Hong Kong MSCI index fell 7.2%. But on the contrary, you know, in the midst of a big fall, right? So I was trading then the Hong Kong index. In fact, I bought some more of Hong Kong Exchange yesterday. So if you guys has been with me in the last market chat, I was bullish on Hong Kong's exchange because, you know, in this whole episode, all right, Hong Kong Exchange, I believe, is the main beneficiary. Okay, and so I remember on Monday, I saw the Hang Seng Index falling by about 2-3%, but there was one stock that went up, all right, and that was Hong Kong Stock Exchange. And question is, why? All right, so what's the reason for Hong Kong Stock Exchange surge? All right, so there's a likelihood that all the 156 US listed Chinese company could be heading home, all right, to listing in the Hong Kong Stock Exchange after the US imposed the rules or say that they intend to impose the rules of delisting Chinese company listed on the Wall Street that is owned by the Chinese government. So what we saw on 21st May, all right, was Baidu indicated that it is looking for potential secondary listing on Hong Kong as the company share has been declining due to delisting fear as US require Chinese company to submit to American standards or risk being delisted. All right, so I really believe that if this were to happen, the Chinese government will not oppose it. In fact, they will welcome it. And it is in the long run good for China and the Hong Kong market. And the reason is President Xi Jinping has in the past indicated that he actually prefers a major Chinese company to be listed closer to home. So I believe that if Xi Jinping had been president earlier, before the listing of a lot of Chinese company on the Wall Street index, he would not have allowed it. So I want to share my trade plan on Hong Kong Stock Exchange. Well, the chart, although it has gone up quite a bit, all right, since it formed a low in March, but according to my trade plan, there's still further room for it to go up. And my first target is 300, followed by 330, followed by 360. So last week when I spoke, all right, it was at 272. Today, the market closed at 282. I think it went to a high of 283. So we have still some room to go. But what I want to point out on this chart, right, is a couple of swing points or swing highs, a recent high that have failed, all right? So you see one swing high here, two swing high here, three swing high here, and this high here is today, all right, achieved today. Okay, so it's coming to test these previous swing highs, and all these previous swing highs really took place in 2019. So after testing all these swing highs, I believe it's going to break, but it's not going to go after the breaking out of this swing high. It's not going to go straight away to take the all-time high or to take my target at 360. It would, I think, hit the first target at 300 first and 330. All right, but if the market turns sour and all these headwinds that we talk about, comes to threaten the market, and the market goes down, all right, 265 and 250 could be a good buy, all right? So these are potential lists of US company that could hit home. And although there's a lot of worries about what will become of Hong Kong after China imposed the new security rulings or new security legislation on Hong Kong. What I believe is now that China has, explicitly said they will take control, what it also means is that they will now be responsible for the city prosperity. They may or they will not allow the property market or the businesses to fall. All right. Remember what I said about what will become of Hong Kong if it loses its status as a financial center and or when it loses its privilege as privilege with US as a trading partner, all right? So what we clearly saw was that stocks that is organic, all right, to the Hong Kong businesses came down. MSCI Hong Kong index came down 7%, but one stock went up, right? Stock exchange. So really, I think clearly the perception of the investing public is they are not really bullish on organic business in China, in Hong Kong. So what I am particularly bearish about, right, is in the long term, right, the Hong Kong commercial property sector could have further weakness, okay? So two things, all right. So one thing, all right, if the pro-democracy protest continues, commercial office space will be vulnerable to asset price decline. And also, if the COVID-19 re-emerges as a second wave in Hong Kong, this commercial property space will also continue to be affected. And the other reason why I'm really bearish on the commercial sector is because of its valuation, all right? So the commercial office, retail, industrial values have risen 720%, all right, since bottoming in 2003, okay? So commercial sectors has been the biggest gainer, all right, followed by retail, and followed by retail space. So in terms of gains, right, the industrial, the most, all right, followed by commercial, and then we have retail space. So I am really bearish on commercial and the industrial space, all right, because it's gone up a lot and it is overvalued. So two stocks that are in the space is the Shanghai property 0016 Hong Kong. All right, so that is why you are seeing there's no rebound since even before the COVID, right? There's no rebound. All right, we have this Shanghai property coming down even before COVID strikes. Okay, and just last week, all right, we saw Shanghai property, all right, hits a new low or a new 4-year low. Okay, so it could be very depressed now, could do a rebound, but in the longer term, looks like there's more room to come down. Similarly, Hong Kong land, also in the commercial property space, you could see that prices has almost halved. All right, sort of all the way from $9, right? Today, it is hovering at 4.07, all right, about $4. So half of the value gone. We could see a rebound from here, but eventually on the longer term is going to be weaker. All right. So today we had the Hang Seng and the Shanghai index rally quite a bit, and that is really partly because of the manufacturing activity unexpectedly expanded in May. All right, so you could see the manufacturing PMI contracted the most in February, then it stabilized, it went back up to 52, and it has been staying around there, and that looks like a good sign. All right, so for this week, as usual on Thursday, all right, we will have our unemployment weekly claim, and then tonight, all right, we'll have the U.S. manufacturing PMI. All right, so watch for this key economic data coming from U.S. And so this is what I have for you for this week of RHO Market Chat. I hope to see you again next week. All right, thank you very much for joining me.